Yeah. Hi everyone. So myself CA Shreyans Jain, and a very good morning to all of you, and a very warm welcome to this webinar session on awareness for United Arab Emirates new corporate tax laws. First of all, thanks for joining this session. So this session is being chaired by Mr. Nasir Mohammed, a chartered accountant by profession with a 30 plus years of industrial and professional experience. He has been in UAE for over 18 years. In the past 10 years, he has been practicing as management consultant. He is providing services in accounting, finance, and taxation matters in UAE. And we at Infominer Services are into the field of audit, assurance, and tax practice in India. And now we are expanding ourselves in Middle East. And we have taken this initiative to spread awareness among stakeholders about the new corporate tax law that will be implemented from 2023 based on the consultation draft released by the UAE authorities. So this session is structured to discuss various matters that will have impact on existing and new businesses in UAE, including free zone companies. So this would be an 2-hour session, which has been divided in two parts. First being the technical session on the law itself and discussion on some practical issues. And second part being the question and answer sessions. We request you to post your questions on chat box or hold your queries till the end of technical sessions. It is most likely that your questions would be covered in the presentation itself. Now I would request Mr. Nasir Mohammed sir to take the charge of this session and give his deliberations. Over to you, sir. Thank you so much.
Thank you, Shreyans. Thanks for the good introduction. And hope I am audible, correct?
Yeah, you are audible, sir.
Yeah. So welcome everyone. As Shreyans mentioned, it is actually an awareness session because as of now we have a consultation draft from the Ministry of Finance. We are waiting for the final regulations. So which is like which can be expected anytime. So broadly, guidelines and the main provisions are given in the consultation draft. So we are not expecting any major changes in the final regulation except getting some clarifications in certain gray areas. So those once we have the final regulations, maybe we can conduct one more session after receiving the final legislation, which is expected maybe any time from now onwards.
Yes.
So thanks for joining on a weekend for this session. I think I can start my presentation, correct?
Yeah, please.
Shreyans,
Yeah, yes, sir.
you have to enable me.
Sorry, sir.
You have to enable me for sharing the screen.
I have enabled. I have enabled.
Okay. Can see my screen?
Yes, sir.
Okay. So we'll start. Like I mentioned, we are waiting for the final regulation from the Ministry of Finance. So all this material that what we um, listed here, mainly they are from the consultation draft and from the Ministry of Finance website, the data that we compiled. So certain provisions may change once we have the final regulations. So all this whatever information that is compiled based purely based on the consultation draft and various uh, information that Ministry of Finance provided in various webinars and seminars. So what is corporate tax? So even now people are asking corporate tax whether it is on turnover or on profit. So it's very clear that it is corporate tax is a direct tax and it is a tax. It is a tax on the company's profit that you make. That is like a bottom line, net of your expenses. Second point, when this corporate tax regime will be effective. So here also a lot of people have confusion. In the consultation draft, what they mentioned, the UAE regime will become effective for financial year starting on or after 1st June 23. So here in UAE, various companies, they follow different financial years, especially foreign owned companies. They have different financial years in their home country. For example, Indian companies, some of them follow April, March, some of them follow July, June, and some of them may follow October, September. So what they mentioned is effective for financial year starting on or after 1st June 23. So that means if your financial year is July, June, you will come under corporate tax regime from 1st July 23. But if your year end is January, December, then you will come under corporate tax regime from January 2024. So this is the confusion people have because everywhere it is mentioned that corporate regime is starting from 23. So the 23 is applicable only if your financial year is starting from July 23. If you follow a financial year, July, June. So that actually most of the companies, they will specify in the memorandum, in the company legal documents, so what is their financial year. Some companies, though they have a financial year in the memorandum as Jan, December, they prepare financial April, March for the sake of convenience, because as of now, there is no requirement to file the audited accounts. They'll prepare July, yeah. I mean, as per the convenience they are preparing. But now they have to look at their legal documents, what they say, and accordingly they have to follow the financial year. So if you are following April, March, and as per your memorandum, it is Jan, December, then then the corporate tax will be applicable from Jan 24 onwards. So please refer your legal documents. So why is UAE is introducing corporate tax? It is like it's a commitment of UAE to meet international standards for tax transparency and preventing harmful tax practices, profit shifting from high tax regime to low tax regime. So what will be the rate of CT? This is also important. So I think perhaps UAE is one of the few countries or is the only country that is giving a threshold. Your net profit up to 375,000 will not be taxed. So any profit over and above 375,000, like from 375,001 onwards, you will have to pay corporate tax. Okay, there are some other multinationals where they say minimum tax applicable for the big companies who have more than 750 million euro turnover. So different tax rates will apply to them. And the question again, many people ask, what is the difference between VAT and corporate tax? And even some of my clients also ask me, we already have VAT 5% and corporate tax 9%. So total 14% burden is coming on us. So that interpretation is not correct, because corporate tax is on the tax on profit. VAT is okay. So corporate VAT is on the turnover and corporate tax is on your profit. So this table I prepared to just to explain. When you are charging VAT to your customer pays that VAT, it is not your income. Similarly, when you pay VAT to your supplier, you claim as input VAT, which is not your expenditure. So the VAT treatment will not change. That will not have any additional impact after the corporate tax comes into effect. So this table just to illustrate key, even after getting corporate tax, your output VAT remains the same, your input VAT remains the same, VAT payable remains the same. But once corporate tax comes, assuming that you have a net profit of 1 million, then you deduct a threshold of 375,000. Then your taxable profit 625,000, you pay 9% on it. And profit after tax is 943,000. So this 56,000 tax, what you pay, if you calculate as a percentage on your turnover, it is coming to 0.56%. So that 5%, 9%, 14% is a wrong notion. So for many SMEs in UAE, making profit of more than 1 million is actually a big deal. So the impact, according to me, is not going to be very significant unless you make tons and tons of profit. And when you are making good amount of profit, I think paying 9% tax is not going to be a burden for you. Again, I just mentioned few points. VAT is charged as a percentage on sale and corporate tax is a percentage on the net profit. So VAT is neither income nor expenditure for you. So we'll move on to the next slide. Okay, another important question. This corporate tax applicable to who? So the law says whoever are residents in UAE. So invariably they come under VAT tax regime, sorry, a corporate tax regime. So the residents, naturally the companies that are registered whether in free zone or mainland, all the companies that are registered and they are operating from UAE, they come under tax regime. So that's why they use the word residents. So sometimes there are joint ventures formed in UAE for a short period. In such case, the partners of the, we call unincorporated partnerships, the partners will be taxed because they see as a tax transparency, because joint ventures are not considered as a legal entities. UAE non-resident, there are foreign companies, who conduct business in UAE through their agents or by having a permanent establishment here. So like a branch of a foreign company, they will be taxable. But here, this permanent establishment is a wider concept, because if a company without having registered in UAE, if they are conducting business through their agent or by appointing somebody on permanent basis, so that will be considered as doing business from UAE. So in such case, one has to account for the corporate tax. Now, another important question is it applicable to individuals? So the corporate tax word itself indicates it's a tax for the companies, corporate, not individuals. So if individuals are earning from salaries, dividends, capital gains, income from shares, even if they have properties in their name, whatever rental income they earn, it won't come under corporate tax purview. But if a person does business like commercial activities in individual capacity, so then the authorities may ask him to register and take a business license. For example, I am an individual, I have money. So I just buy and sell cars regularly. Every week I'm buying car and I'm selling car, I'm making money. So that is considered as a commercial activity. I have one car, I sell, and I buy one more car. That is not commercial activity. But I have some capital, 500,000, then I buy 5 cars and I sell. I keep doing this throughout the year. Then it will go to the notice of the authorities. Then they will come and ask me to register for the register and take a business license and do the business officially. So there are many people, to my knowledge, doing a business in their individual capacity. Since there is no taxation till now, nobody was asking, but once the corporate tax comes into effect, so these transactions will be monitored. Move on to the next slide. So anybody is exempted from tax. So they, as of now, exemption is for the companies that are into extraction of natural resources because they have a different government level corporate taxation. So they are exempted, and some investment funds which are held by individuals, that is also exempted, which we will discuss later. Then question is, what is profit? How do you calculate profit? The profit, what we do, we call it as the tax authorities, they will say, we will tax you on your adjusted profit. What is adjusted profit? There are certain expenses that are not allowed to be claimed as an expenditure because that will reduce your net profit. So those we are going to discuss in the next slides. So again, what the law says, you have to maintain books of accounts as per the internationally accepted accounting standards. So many people know that in UAE, suppose you pay December salary in January. So you account a salary in January or December, for you it makes no difference as of now. Similarly, there is one invoice you, instead of booking in December, you book in January. That is also, even if you have VAT within the same quarter, it makes no difference. But once corporate tax comes, you have to do it on accrual basis. December invoice, you have to book in December. You cannot take it to the next year. So those are the international accounting standards, accounting on accrual basis. So dividends and capital gains are exempted. Suppose if a company has invested in shares of another company, if they get dividend, that is not treated as a business income because it is the income earned from investment, not from doing a business activity. Moving on to the now the most contentious topic is free zone. So maybe I'll take some time to explain, and maybe most of you have a lot of questions on this. I'm sure, so we can answer these questions at the end of the sessions. So the free zones, because when the free zones were introduced in UAE, the government has given assurance that they will be tax-free zones. So government is going to honor that commitment. So what will they say? Free zones that are doing business within the free zone, they will have 0% rate of tax. So, and that means one free zone doing business with another free zone company in the same free zone will be exempted. Even if you do business with a company in other free zone, you know, Dubai, UAE have 40 plus free zones. If you do business with another free zones also, they are out of purview of corporate tax. And a free zone company does business outside UAE, like they are into fully exports. They do production in a free zone and they export. So they don't come under tax purview, they will be exempted. The second case is a free zone company. You know, in UAE, there are designated zones. Not all the free zones are designated zones. So designated zones are those zones where there is a restriction on movement of goods. Okay. So if a free zone company sells to a mainland company and the mainland company, the person who is buying has a import-export code. He will import using his import code. So in such case, it will be treated as an export from free zone company. So it will be exempted. But as per the regulation, if a free zone company does any business with a mainland company, they will totally lose the tax exemption. So they will have to pay tax on their entire income. The exemption is if you are in a designated zone and if you are selling a goods to a VAT registrant and who is using his import code. Then only it will be treated as a export from free zone. Then it is exempted. But services, if you are providing services to somebody outside free zone, then it will be definitely treated as a taxable supply. So you come under corporate tax regime. One more important point to note is free zone company having branch in mainland, because it is possible. So a free zone company, I have set up a company in free zone, I have set up a branch in free zone. So in such case, what will happen? So they have mentioned mainland income will be taxed at 9%, free zone income will be taxed at 0%. So that means you have to have a separate set of books of accounts for the mainland as well as for the branch, separate. Then you should be able to demonstrate whatever income earned by a mainland company is from the mainland, whatever income earned by a free zone company is from the free zone. So from income earning perspective, they are all independent entities. Coming to the fourth point, transaction of a free zone company with a group company in the mainland. Now it is possible. What happens? A free zone company has a group company. Group company we will discuss in the coming slides. So what happens if a free zone company buys from a mainland company? So if a free zone company buys from the mainland company, then what happens? And payments made by mainland company to a free zone company. This is a case where free zone company sells to a mainland company, and the mainland company pays to the free zone company for the supply. So in such case, free zone company will be taxed at 0 rate, but whatever amount paid by mainland company will not be allowed as an expenditure, because the income earned by free zone is already taxed at 0 rate. So this is a case where a free zone company sells to its group company. So in such case, is it violating the rule that it should not deal with the mainland company? So the clarification is that free zone company can claim it as a 0 rate, but the same amount paid by the mainland company, it is not allowed as expenditure in the mainland company, because this whatever sale happened is already 0 rated in the hands of free zone company. So if you allow this expenditure to be deducted from the mainland company, that means the government is giving double benefit. One time exempting the income of the free zone, one time allowing the mainland company to deduct the expenditure, which will reduce the profit of the mainland company. So another scenario, mainland company having a branch in free zone, it can happen the other way around also. A mainland company having a free zone, so the same rule applies. You have to have separate set of books, and whatever income generated by a free zone branch, it will be exempted. Whatever income generated by mainland, it will be taxed at 9%. Here what they said, if a free zone company earns income from a mainland company, they will lose exemption, but they have given some exceptions. If they earn any interest on deposits, any dividends and capital gains, suppose a free zone company invest in a mainland company in the shares, and they may get dividend, and they may sell the shares and they get capital gain. All these are treated as passive income. They are not the income generated from business, so they will be exempted. So this is the one of the exemptions government has given. Now the question comes: I am in a free zone. I am not dealing with the mainland. I am exporting from free zone. Do I have to register for corporate tax? The answer is yes. How the government knows you are dealing with the free zone company, you are dealing only with free zone, not with any other company? So that way, how the government will know whether you are earning 0 income or not. So even a service provision also, one of the questions is, if free zone company provides services outside UAE, so that will be exempted from tax, because as per the guidelines given, it is not provided to a mainland company. Because for all practical purposes, free zones are considered as outside the jurisdiction of UAE. Now we discussed who is who will come under tax purview, who are exempted, and what is the tax rate. Now we have to see what do you mean by adjusted profit. So adjusted profit, when we say adjusted profit, once the corporate tax comes into effect, so I prepare my financial statements, I declare my profit as X amount. So is that accepted by government authority? So definitely not, because there are some adjustment government actually will make, the tax authorities will make some adjustment, some expenses will be disallowed, then your profit will be added back. So some of them are like entertainment expenses, they said only 50% will be allowed. And the depreciation, we are expecting that the government is going to specify the depreciation rate, because depreciation is for some companies a major component of expenditure. So to reduce profit, I will say I will charge 30%. Whenever I make high profit, I will say I will charge 30% depreciation. I will charge 20% depreciation. So the government is going to specify what is the eligible depreciation rates, and we are waiting for this information. Depreciation and revaluation of asset, because a lot of people ask me, we will revalue asset. Now my asset is 1 million, its market price is 5 million, and I will revalue and I will claim depreciation on 5 million. So it won't be allowed, because they have mentioned unrealized gains and losses will not be allowed. So depreciation, the payment that are not treated as expenses, taxes, penalties, interest on overdue tax payment. Suppose if you pay tax, you are paying tax on profit. So the tax is not an expenditure. Similarly, you pay penalties, like you are delayed in filing VAT returns, you get penalty. So that penalty you cannot treat it as your expenditure. So in almost all the tax regimes, so these expenses are very standard, they are disallowed. So expenses that may exceed limits that might be set by tax authorities. So maybe there can be some more limitations the government may set going forward. For example, maybe salary of the partner, they are going to have some limit. So beyond that, they will disallow. Provision for expenses not incurred. So you say that I make a provision for bad debt. So, but unless it become bad debt, the provision is not an expenditure. So this adjustment they are going to make, I have a table just explaining how the profits are adjusted. Now, when we say adjusted profits, so like, do we have a lot of time to prepare ourselves? So actually, we don't have too much of time, because once the corporate tax comes into effect, so let us say first year 2024, there is always comparison of profit with earlier periods. Suppose 2023, we should say it should be a base year for you to set things right. Whatever you are doing, the companies they are doing, as of now, because of no tax return filing requirement, nobody is asking. But now, once 2024 comes, suppose your revenue suddenly drops by 30% from previous year. Your profit suddenly in 2023, you made a profit of 1 million, in 2024, you made a profit of 100,000. So there is going to be definitely a comparison to see if you are resorting to any tax evasion methods. So these are the disallowance, some expenses given in the consultation draft. These expenses are going to be disallowed. One is the interest on loans, which will be very interesting. What they say, interest on any loan, which is you pay, will be restricted to 30% of profit before interest. This I have an illustration in the next slide, how it works. So more than 30% of your profit interest, it will be disallowed. One more important question people ask: if group companies give loans to another group company, one group company give loan to another group company. So in such case, what they say, it will be treated as a related party. You should establish, given it should give basically a commercial reason for taking loan. I take a loan from group company for doing business, but I take a loan to repay another loan of another group company. Then I claim interest on the loan, which will not be allowed. So what they say that the commercial reasons must be established. There should be a commercial reason for borrowing loan. Just because I can deduct my interest amount from my expenses, I just cannot borrow 1 million and pay 90,000 interest just to reduce the tax. So the borrowings are going to be uh, questioned from commercial reason point of view. Then entertainment expenses, like you receive your customers, you entertain them, you conduct parties, you conduct some events. So those things they said they will restrict up to 50%, because law government is recognizing the fact that you are bound to incur some expenditure. But if they allow you to claim everything, then maybe people start claiming a lot of expenses, as entertainment. Even their personal expenses they will claim, and they say that it is incurred for to entertain the guest. So government is discouraging that. Okay, but we'll give 50% of allowance, and then we'll allow up to 50%. Related party payments made to a free zone, which I discussed before. A free zone company buys from a related party, and related party for the material they bought from the free zone, they pay to the free zone group company. If it is a group company, then the expenditure is not allowed in the hands of the mainland company. Fines and penalties, which I already discussed, you pay any fine, you cannot treat it as an expenditure. Payment to connected person, it is one more important point. You have group companies, you have like directors, shareholders, their relatives working in the company, drawing salary, booking their vehicle expenses, paying for the school fees of the children, and paying for the residence houses of the director shareholders. So they are all going to be disallowed. What they mentioned, it should be with the market value of the services provided. So it is expected that there is going to be some restriction on the salaries benefits given to the directors and the shareholders. So they are going to see the market value. For example, a director, a shareholder, his children's school fees is booked in the company. So far nobody has asked why you are booking. So, but then once the tax regime comes, there is going to be a question: how the school fees be a business expenditure, and you are taking salary, and also you are taking house rent. Your house rent is paid by the company. You are driving a Range Rover, and you are incurring 10,000 dirham expenditure on that. So all those, there is going to be a cap, which is as of now not announced. So it's most likely there's going to be a cap on the expenses paid to the connected person. The one more thing, one more disallowance will be unrealized gains or losses on capital items. Like for example, I say that I bought one asset for 1 million. Now its value is only 500,000. I will reduce the value, and 500,000 I will claim as my expenditure, which will not be allowed. But why they set capital items? Revenue items, for example, stock. The stock to be valued at the cost price or market prices, whichever is lower. Suppose you bought your inventory for 100,000. Today its market value is 70,000. So as per international accounting standard, you have to revalue your inventory to the market price, which is lower than your cost price. So that will reduce your, like, inside 30,000 you have to write off. That will be expenditure that will be allowed. That's why they have used the term capital items. not on the revenue items. So this table to explain how the tax authorities will calculate the tax. On the left hand side is like, as a taxpayer, I have maintained my books of accounts. I have calculated my profit, $500,000. I said, as per my books, $500,000. Then I claim a limit threshold 375,000. I will say my taxable profit is 125,000. I'll say, according to me, tax liability is 9%, 11,000 to 50. But then tax authorities will come and inspect your books. They said, okay, your profit is $500,000. But okay, now partner salary, you claimed excess. So like I said, it is still not announced what is the cap, but it is a likely scenario. It is like, I have written for illustration purpose with assumptions. This is what most likely going to happen. And entertainment expenses, you booked 40,000 and here you have not deducted. So they said 40,000, 50% is only allowed. So 20,000 will add back to your profit. And prior period expenses, you bring some 2022 bill and book it in 2024. So I say I forgot in 2022, so it won't be allowed. And you paid income tax, let us say in 2025, let us say this is a return of 2025 and you paid income tax in 2024 and you want to claim as expenditure, it will not be allowed. You paid a penalty for late filing of the VAT return, or you paid a traffic fine. So this, according to it, is an expenditure, but according to tax authority, it is a disallowable expenditure. So, and coming to the interest, let us say you incurred an expenditure of 450,000. So what they will do, they will add back this 450,000 and calculate 30%, and they will see whichever is the lower. So first they will add back, then depreciation also, whatever you calculated, they will add back, and some provisions they will add back. They will arrive at this profit, and then they will deduct whichever is allowable. For example, interest. So you arrived at a profit before interest 800,000. So 30% of 800,000 is 391,500. Sorry, 1.3 million, correct. So disallowed expenditure is 800 and your profit is 500. So your net profit according to authorities 1.3 million before interest. So they will calculate 30% of 1.3 million, which is 391,000. Whereas you claimed 450,000. So they are adding back 450,000, they are deducting 391. So the net impact is the difference only they are adding back, which is 450,000 minus 391.5. So 58,500 they are adding back. So I think it is clear from this table. They add back 450, they deduct 391. So the excess amount what you claim, they are deducting. So again, depreciation you claim 200,000, but as per the eligible rates, you are eligible for 150,000. So they deduct 150,000. So this 200 they are adding back, they are deducting 150,000. That means 50,000 they are allowed. Now, according to tax authorities, the adjusted taxable profit is 763,500, whereas according to it is 500,000. So this is how they will calculate your profit and say, in most of the cases, when you are filing the return, you are expected to do this adjustment yourself. Otherwise, it may amount to hiding the information. So when you are giving your tax returns to any tax consultant to file, he does all this and declare the correct profit and pay. Whatever you want to book in your books, book. There's no problem. It is not that you are not allowed to book expenditure, but you are not allowed to claim as expenditure for tax purposes. So this 763,500 is, they say, according to us, this is taxable profit. You deduct 375,000, your taxable profit is 388, and you pay 99% on this. So now you see the difference. According to me, is 11,250. According to tax authorities, it is
Okay.
34,965. So this is an illustration. This can be, for example, in millions of big
Okay.
companies. Big companies who are making a lot of profit. The adjustments will be in a big amount. Hope this table is clear.
Yeah.
Okay, now carry forward. Okay, now we discussed about profit. Now the $1,000,000 question can be, what if we incur loss? So the losses, business is seen as a going concern. So 1 year you may make profit, 1 year you may make loss. So let us say 2024 you made a loss and 2025 you made a profit. So you are allowed to set off the loss of 2024 in 2025 up to a maximum of 75% of 25 profit, 2025 profit. For example, just to give an example, you made a loss of 1 million in 2024. You are allowed to carry forward that loss, but in 2025 you made a profit of 1 million. But up to 750,000, they will allow you to set off. They want you to pay some tax when you incur profit. So that balance 250,000, you have to pay tax. When I say taxable profit, I'm saying it is after removing the minimum threshold limit. Also, there are certain restrictions. When you carry forward the losses, you may sell the business afterwards. So they say at least 50% of the shareholding should be continued when you are setting up the losses. But in some special cases, they will allow, even if the partners are not same, you have to apply to the tax authority. Even if the partners are not same, we bought the business with the losses. So we should be allowed to carry forward the losses. The tax authorities may consider if the nature of business is not changed. So for example, I am running a restaurant. Then after buying, I will convert into centralized kitchen, or I introduce bar. So then the nature of business is changed. If the nature of business is same, and if you buy a business with that has already incurred a loss, you may be allowed to carry forward the loss. So that clarification they gave in the consultation draft. So the question again, what if I have losses before 2024? So losses, profits, they say they are not relevant before introducing the corporate tax. Losses incurred before effective date, not allowed to carry forward. And losses incurred before a person becomes a taxpayer. For example, I registered in 2024, but I started doing business in 2025. Then I incurred a loss in 2024, but it is below, since it is below threshold limit, I have not paid any tax. But afterwards, I want to claim. That won't be allowed. Then losses incurred from activities of asset generate income that is exempt from UAE. Assets which activities that losses incurred from activities are assets which generate income. If it's already exempted, again, you cannot, if you incur any losses, you cannot claim. For example, the capital gains, you incurred a loss on the, shares, the selling shares and all. So that you cannot claim as an exemption. So losses incurred by a free zone person, that is not attributable to the permanent establishment in the mainland. For example, in the free zone company, I incurred a loss, and next year I start dealing with the mainland company. Then I lose exemption. Then I earn profit. Then I will say when I am conducting business as a free zone company, I incurred loss, and this loss I want to set up against the profit that I earned from the mainland company. So that won't be allowed. So a free zone company given a 0% tax benefit, so they cannot say that, okay, I made a profit from the mainland, then I want to set up the loss of a free zone company. That won't be allowed because both have a different tax treatment. Now, another
Sir,
point, another point.
sir, there's
Yes,
one
yes,
small doubt about the losses. So can I
yes,
ask now?
yes, yes. Okay.
So about the subsidiary companies and the joint venture companies.
Ah,
So, like according to the IFRS 11, they have to take the losses or the profit in the books of accounts of the holding company, right?
correct.
So how they treat that?
Okay, see, joint ventures, if it is like they say unincorporated partnerships. So joint ventures, if they are like unincorporated partnerships, it will be taxed in the hands of individuals. Okay, subsidiaries, we say, you mean the subsidiary of a foreign company or you subsidiary of a UAE company in the foreign land?
Within the UAE itself, sir.
Yeah, so what, subsidiary, yeah, 70, that I'll discuss. See, 75, if it is a holding subsidiary company and if it is a group, there will be only one tax return.
Okay, all right.
So that I am discussing in the next slide. Okay. So this is the point.
Nasir
This
sir.
is, yeah.
Yeah, so another question we have from Srinivas A.
Uh,
So he is asking that free zone services provided to outside UAE, is it taxable or not?
yeah, it is as of now, it is clarified that as long as you are not dealing with a mainland company, it will be exempted.
Okay. Okay.
So that is as per the consultation draft. If you are not dealing with any local, because that is the tax benefit declared by UAE government when they are forming the free zone companies.
Okay.
Free zone companies doing services within free zone or with any other free zone company or outside UAE, they are exempted from tax.
Okay.
Okay, now tax groups, related party, connected person. So this will be some interesting topic. So tax group, what they said, you can form a tax group if there is a holding subsidiary relationship, holding company holding at least 90% of shares in the subsidiaries. Then what happens? You can form one group and you will be filing one return. So then there is no intercompany sale purchase. Even if it happens, it will be treated as a one group, like we have a VAT group. So it will be treated as, if it is subsidiary, 95% shares, then it is simple actually. So there will be only one tax return. So related parties, when we say related parties, I have two licenses, but they are not holding subsidiary company. I have one company in Dubai, I have one company in Abu Dhabi, I have one company in Sharjah. So if I say if I am holding 50% or more shares, I'll be treated as a related parties. But here tax group, if I am having three companies, but they are independent companies because their licenses are different, then I have not formed them as subsidiaries. I formed them as standalone companies. So they are not treated as tax group. They will be treated as related parties. If I have more 50% or more share or voting rights, then I'll be considered as a related party. So any transaction between related party, again subject to transfer pricing rules and market prices, market price comparisons. And connected persons, what we mean by connected person, so I am a shareholder having more than 50%. So my family members, my wife, my son, my daughter, they will become connected person. So I myself, I am a director of a company. So I am a connected person. Individual related to the owner, they are connected person. So they are saying up to the fourth degree relationship, kinship, you will be treated as a connected person. So fourth degree of kinship, or including by birth, marriage. Fourth degree means it can be father, grandfather, son, grandchildren, then nephew, niece, almost everybody. So I think fourth degree kinship covers most of the close family relationship. So why we are having connected person? Any payments made to this person shall be justified that they have commercial reason and they are on par with the market prices. I pay salary to my son. let us say 20,000, and maybe he is an accountant, he's doing accounting work. So, and I pay to the finance manager 15,000. Whatever that doesn't sound to be reasonable, doesn't look to be reasonable, and these payments made to any related parties, connected persons, will be subject to uh, restrictions, subject to the conditions that is going to be laid down in the regulations. We'll move to the next slide. I think carry forward of losses is yeah, this, I think this point is clear. Okay, I think one point I have missed maybe. Holding subsidiary company only if there is a 95% shareholding. But they say if you have a group company where you are holding more than 75% share, then you can set off losses of one company with another company. Where is this mentioned somewhere?
Hello.
Yeah, I'm just looking for the point where I have mentioned. Somewhere in the presentation I mentioned. So even if it is, even if there is no holding subsidiary relationship, if I have two companies where I hold more than 75%, so I am allowed to set off the losses of the one group company with another group company. So that relief is given by the law. Now the questions a lot of people ask, in UAE there is a VAT group, because 2-3 companies form one VAT group and they will file a single return. So the question they ask, whether this group, the VAT group already we have, can it be used as a corporate tax group? Can the same group be a corporate tax group? Answer is need not be, and most likely it won't be, because corporate tax group, they said only if there is a holding subsidiary company. For VAT purposes, if there is a common management, if there is a 50% control on another company, and there are 3 criteria given. If they are financially independent on each company, also you can form a VAT group. But corporate tax group has a different criteria. So answer to the question is VAT group and corporate tax group need not be same. They will be different. They can be different. Like I said, corporate tax group is only 95% of the, only if there is a 95% parent and subsidiary company relationship should be there to form a tax group. So it is clarified in the consultation now. Again, coming to transfer pricing rules, again, we discussed connected persons, group companies here. So coming to the transfer pricing, what is transfer pricing rules? So transfer pricing rules, what they say, if you are dealing with your related parties or connected person, the transaction should be arm's length. Arm's length means if you are selling your product to someone at 100, so you should be selling the same product to your connected person at 100. If you are selling over and under with a intention of shifting profit from high tax paying regime to low tax paying regime, then the transfer pricing rules applies. Then the transfer price, whatever price you use for sale and purchase, that will be adjusted to arrive at your taxable profit. So one example I have given here, for example, company A, there is a tax of 9%. Company B is in a different country with 0%. So market price of one product is 15,000 I will sell this to company 10,000. The 15,000 item I'll sell to a company for 10,000. So the 5,000 I am understating. That means I'll be paying 450 less. I transfer this to a country where there is 0% tax. So, and this 10,000 I'll sell it for 15,000 where the tax is less. So this 5,000 profit I'm shifting from tax paying regime, high tax paying regime to low tax paying regime. So I am saving a tax of 450. So these are subject to OECD transfer pricing guidelines, Organization for Economic Cooperation and Development. It's actually a very big topic. There are, I think, 600 pages guidelines given by OECD for transfer pricing. So basically any attempt to suppress profits or shift profit from high tax paying regime to low tax paying regime, it will be discouraged by applying transfer pricing guidelines. So this is actually a big topic, but broadly, this is the concept. If you try to transfer your profit share, then from high tax paying regime to low tax paying regime, you will be subject to transfer pricing rules and your profits will be adjusted accordingly. So other important provisions, some of them I have just listed. Question is that, okay, tax is only after 375,000. If I make profit of 375,000 or more, then only I have to register tax because I don't come under threshold. So the answer is you have to register for corporate tax, because in VAT, if your turnover is less than 375,000, you are not required to register. But in corporate tax regime, all the licensees have to register. They have to file the return even if you are below threshold limit. Otherwise, government will not know whether you are making profit or not. So how often the tax returns, when we have to file the tax return? So it's also again important provision. So what they are saying, after within 9 months of closing of your financial year. So one example is if your first year of tax will be 2024, you will close your accounts in December 24. So you have to file the tax return within 9 months. That will be September 25. And payment of return and filing of return and payment of tax should happen within 9 months on or before September 2025. So most of the companies here in UAE follow January, December. So for most of the companies, September 2025 will be kind of deadline, a very important time for them, September 25, where they have to file the corporate tax returns. Once the final tax regulations is released, so they are going to give you guidelines or explain how your company can register yourself for the corporate tax regime. You have to register, maybe you will get one tax identification number, then you have to file your return after 9 months. I mean within 9 months of closing. You can even file within 1 month. How to file the CT return? Again, they mentioned like the way we file VAT return, there will be separate registration. You have to file the corporate tax return. Again, question like most of the tax paying countries, you have to pay advance taxes. Like India, you have to pay advance tax 3 times. In UAE, that requirement is not there. That is a big relief for the companies. Will there be any penalties for non-compliance? For sure, there will be penalties for not registration, for not filing, late filing. But how much fines and penalties? It is not yet announced. But most of UAE residents are aware that penalties are going to be heavy in UAE. Any non-compliance will attract huge penalties. Will there be withholding tax? So this is again important topic. In most of the tax regimes, the payer has to deduct some tax. In India, we call the TDS, tax deducted at source. In other countries, it is called the withholding tax. So if you are paying, if you are making payment to any foreign person, suppose you hire services of a lawyer in London, you make the payment. In other tax regimes, you have to deduct tax. But in UAE, there is no such a requirement. You don't have to deduct tax. It is considered as 0%. There is withholding tax at 0%. That means you are required to maybe record these transactions. That maybe you have to declare to the tax authorities your tax, like you made payment to foreign person, so much of amount you made payment. That has a 0% withholding tax. So maybe government wants to compile that data, see how much foreign payments you are making, how much payments you are making to a foreign person. So there is no withholding tax. Again, free zone companies, there is 0% tax, but if free zone company earns from mainland sourced income, then it will be 0%. That means free zone companies have to keep a record. Like I mentioned, a free zone company sells to a mainland company who has who uses his import code. So that will be treated as an export from free zone company. But again, that will be subject to 0% withholding tax. What do you mean by 0% withholding tax? That means the government wants to have a record. Okay, we are exempting, but we want to know how much business you have done. You declare and you say 0%. In VAT return, we say export sales at 0%. We have to put the value. It has no tax impact, but you have to declare that I have done a 0% VAT supplies. It can be 1 million also, 0%. You just declare, it has no tax impact. Similarly, in corporate tax, you may have to declare how much sale you have done that has a 0% tax. Again, group companies, can group companies form a tax group? Again, I have just repeated because this is one of the important provisions, only if you have 95% of shares. Again, here I mentioned 75%, sir. What if one of the group companies makes profit and other group company make loss? It is allowed to set off loss of one company to the other group company. So this answers the question of holding subsidiary companies. Automatically it will be set off. But here they gave one more relief. I have two companies where I have more than 75% ownership. So then I am allowed to set off the losses of one group company with another group company. So details on this are awaited, how much they allow, what are the conditions, the details are awaited. One more important point, if a UAE company pay tax in a foreign country, suppose a UAE company has a branch outside, let us say in Europe. So what should we do? The branch earns profit. Earlier we mentioned that UAE company if earns profit anywhere, they have to declare here and pay tax here. But the law is giving you some, relief. They say if this branch is paying a tax in the foreign country, so you can claim tax credit here. You declare that income and you show the proof that you paid tax in foreign country, then it will be exempted here. So that exemption is subject only restricted to 9%. If you pay 30% in Europe and that 30% you cannot claim, you will be allowed exemption only up to that 99%, which otherwise you would have paid tax on that. So you can claim credit of whatever tax you paid in a foreign country. So who will be the tax authority in UAE? So they declared federal tax authority FTA that is handling VAT as of now. So FTA is going to be the final authority, the governing body for the tax related matters. So here this slide is just to the owners of the company, where since the corporate tax is coming, do's and don'ts, maintain you start maintaining your books as per international accounting standards. Use proper software. Many people in UAE, they still maintain books manually in Excel. Small companies, they maintain in Excel. And many companies, they have license in Dubai, they have license in Abu Dhabi. In Dubai also, they have 2, 3 different license. They have only one set of books, which will create a problem once you have a corporate tax regime. You are expected to maintain separate books of accounts unless it is a part of one group, unless there is a holding subsidiary company. There you are supposed to have a separate set of books of accounts. To have adequate internal control and all this is something normal. Have proper inventory records, because inventory, once you are dealing with inventory, the questions and queries from tax authorities are going to be more, and they are going to scrutinize more, because that is where people try to manipulate, understate inventory, overstate inventory, to manipulate books of accounts. So make sure that you have proper inventory records built in your ERP. Cash transactions, again, as of now, nothing is mentioned. Cash transactions, there is going to be some limitations. Beyond this limit, you cannot purchase in cash. That is all expected. So avoid, backlogs in account, because 2024, when you prepare balance sheet, that balance sheet is subject to scrutiny. Suppose you have not prepared accounts for last 4 or 5 years, so you will have a lot of difficulty in closing 2024 accounts. Payments, whatever accounting entries, make it on accrual basis. Try to avoid manual books account. You can have as a subsidiary supportive, but not mainly manual books of accounts. Booking of expenses of personal nature, all this to be avoided when you have these corporate taxes. Entries to facilitate others, in UAE normally, like I take loans or I have bank facilities, I allow my friends to use, all those things are going to be like scrutinized. So you have to be careful with such transactions. Now, way forward, this is, I feel, very important slide for business owners. So now there is a scope for you to be prepared and do some tax plan. For example, I give some example. So change of financial year. Suppose from Jan, December, if you change your financial year, April, March, you will get additional 3 months time, because as per the regulation, any financial year starting after June 23. Suppose you change your financial year April to March. So your tax regime will start from April 24, not from January 24. But again, you have to do proper study and see whether it is advantageous, not advantageous. It is not general, rule, or it cannot be applied as a blanket, permission to do it. You have to really see whether it makes sense if you change your financial year. Company structure, again, some people ask me, because if there is no holding subsidiary company, I have a company in Abu Dhabi, I have a company in Dubai, I'll make Abu Dhabi company as a subsidiary of a Dubai company, because they get around. But there you have to see, once you form a group, you will get a threshold of 375,000 for the entire group. But if you have 2 different individual companies, you will get 375 for each company. So, but at the same time, after a certain limit, it may not make much a difference, because the intercompany sales you have to do at market prices. So that may create a lot of complications. You have to see which is more advantageous. So that for that purpose, company structure has to be studied, nature of business has to be studied, practical difficulties have to be evaluated. You may have inventory in Abu Dhabi, you may have inventory in Dubai. For you, as of now, it is you have only one average cost. Once you separate, you will have different average costs. So how practical it is, you have to see. And make previous year comparable, like I mentioned, 2023. You should have proper You should set things right in 2023. Whatever you have been doing, you make 2023 as a model year, which can be replicated in 2024, because definitely earlier year figures are going to be compared. The other point is make separate books of accounts for each entity. So each entity you start making separate books of accounts. If you are making already, if you are making only single set of accounts, you have to start separating. There are some practical problems for many UAE companies I have seen. They have two licenses, but they have only one bank account in one of the companies. So they cannot separate it. Practically, as of now, I have seen many companies, they cannot separate it because they use only one bank account. So, but you have to find a way of doing it. Because the tax authorities are not going to accept one set of books of accounts. One more question, somebody said I am in a free zone. So if I set a branch, if I set up a branch in mainland, so I can claim exemption for the free zone company. I can separate my income, free zone income and mainland income. So at least free zone income will be exempted. But again, if you want to set up a branch, how much it will cost? The cost what you are going to incur for setting up a branch, will it justify the tax savings? Suppose by setting up a branch, you are able to save 30,000, but your branch setting up will cost 40,000. So it will not make sense. But if you have a significant income from the mainland, if you want to separate, then it makes sense. So each case has to be studied separately. Have proper planning for payment to connected persons. This is also important, like connected person means, like now one director is taking 100,000 salary. Maybe they can have a plan, bring other family members, and maybe distribute the salary. So one will take 20, another will take 20, another will take 10, something like that. So this have to be planned. And also some expenses you incur for business promotion. You know, to get some business, you incur some expenses. How do we account for it? So you have to have proper planning. Another important question, a lot of people are ask me, holding assets in the name of the company is beneficial or in the name of individual is beneficial? For example, many of us have, I mean, not many of us, I mean, see, many of UAE residents have properties in their name, personal name. So income from personal properties held in personal name, they are not taxable. But if you transfer this to a company, then the income from that property is taxable. But it is not a general rule of thumb. So, okay, income is taxable. At the same time, expense is also deductible. If you transfer an asset, maybe you can claim depreciation. And you can book expenses of the maintenance of the asset in the books of accounts. Maybe you will get more benefit if you transfer your assets to company. And if you are not getting benefit, maybe whatever assets you are holding in the company name, you transfer to personal name. Again, you have to see when you transfer, do this transfer, there is a 2% or 4% registration fees for transfer of asset. So is it worth doing or not worth doing? Each and every case you have to evaluate and take a decision. Intra-group transfer of assets, or what they said, now I have companies in Dubai, Abu Dhabi, I am the owner. Once the tax, I have an asset in Dubai company, I can transfer to my Abu Dhabi company. I mean, nobody's asking now. So tomorrow what they're saying, you can do only if there is a common ownership of 75%, and that asset must be held for 3 years. So to avoid future complication, any assets and liabilities you want to transfer from one company to another company, before the tax regime starts, better you do it before starting. Before starting of corporate tax regime. So all this, you have to look at your business model, your legal structure, your expenses, your intercompany transactions, intra-company transactions, payment to connected persons, everything you have to remove, you have to review and come up with a proper structure that will help you to migrate to tax regime. So this needs, definitely a review from a professional. So it is worth doing it. And if not, surely you are expected to face problems in the coming years. So that ends my presentation. Thank you very much for attending this webinar. And we can take questions, and any questions that may take a long time to answer, elaborate, you can always reach out to us. Send your questions to this email ID. We will come back to you with the detailed explanations. So now, we are open for question and answers.
Yeah, thank you so much, sir, for your deliberation. So I have a question from Mr. Hussain. So I'm just posting it on your message, sir. Please.
Okay.
Have you received, sir?
Yeah. Yes, if I have the question, if I have one company as a major shareholder under my name in Sharjah and have another company in Dubai with my spouse share, will be treated as a related party. So definitely it will be treated as a related party because they mentioned if anybody have a 50% share directly or indirectly through a related party up to a fourth degree of kinship. So husband and wife, definitely these dealing transactions will be treated as a related party transaction. Hope that answers the question.
Yeah, thank you so much, sir.
Because it's clearly mentioned up to the fourth degree of kinship.
Yeah. So I would like to ask the other participants if you have any question, you can post it over the chat.
Post or you can unmute and ask the questions.
Yeah.
Or raise hand so that they can unmute you.
Yes.
Sir, Naveen here.
Yeah, Naveen.
So the query about the investment companies, so which have the 100% holding and made investment and receiving the cash dividends every month. So for the holding company, it is a regular business to them to get a dividends. So how it treats in the holding company and subsidiary company as well. Is subsidiary companies is taxable or not?
Your question is about holding subsidiary or investment?
In the holding company activity is investing, sir.
Okay.
So it is investing to other companies, which is 100% subsidiaries,
Okay.
and they will run other activities like hotel or restaurants. They'll generate profits, and they will retain certain amount of profit with them, and the 90% of profit they are transferring to the holding company as a cash dividend.
Okay.
So here, where is the point of taxation? Like in subsidiary company?
There won't be tax on dividend because your profits are already taxed.
Okay.
There won't be tax on tax on tax because dividends, what they mentioned, are exempted. So suppose you are saying subsidiary companies, they earn profit. So those profits are already taxed at 9%. So the dividends they have exempted, especially they have exempted the dividend earned by any company, corporates. It need not be holding company. Even if a company, I have a standalone company, I invest some amount in other company, and that other company pays me dividend. So that dividend is not taxable because they are considering the point that already your profits are taxed. So then there will be no double taxation because here they are exempting, in UAE they are exempting dividends as in exempted passive income kind of thing. But investment funds have a different story, closely held. So that's a different topic. If it is just investment is, if it is not a closely held investment, then it will be exempted. Like when we say investment funds that will invest funds in the stock market, all that, that's a different story. But these holding subsidiary companies, anyway, they'll have to file a tax return and they declare profits and they pay tax. Again, getting dividend from one subsidiary by a holding company by subsidiary, it won't be taxed.
All right, sir. Thank you, sir.
Hmm.
Yeah. So we have another question from a participant in Samsung SM. So you can ask your question.
I think he posted owners building rental net income will be taxable. There are shareholders in the group. No, this question is not clear. That means if the building is owned by a company, is it? Can you just clarify? Maybe you have to unmute him.
Yeah, he can unmute himself also. The
So
name
this
is not-
question is not clear. Whoever is asked
Yes,
about
yes,
the
yes.
owners building rental.
Yes.
So what I understand is if the income from building rental is taxable or no, net of expense. If it is held by a company, if the building owned by the company, if they earn rental income, yes, it will be taxable. And any expenses incurred on the building maintenance and all that can be claimed as expenditure.
So one more, sir.
Uh,
Sir, about a sole establishment company. So the owner has taken a vehicle on his personal name and is
uh,
paying installments from
your voice
company
is
and is
breaking.
acting as a.
Yeah.
Okay, 1 minute, sir.
Okay.
Hello, sir.
Yes, yes, yes.
Yes, sir. Now, a sole establishment guy who has purchased a vehicle and is
Hmm.
claiming all the EMIs into the expenditure of the company, sir. So how we have to deal with that?
Again, going by the accounting principle that EMI is actually not an expenditure. Okay, because if it's a sole establishment, then he has to again file the tax return and the account, whatever the profit, whatever he has earned, it has to be declared. And he will be like a sole establishment which is registered as a commercial entity. So what they say, whether the activity requires an individual commercial license, natural person who is engaged in business and commercial activity is subject to UE corporate tax regime, correct? Any person who is doing a commercial activity is subjected to corporate. So he has to file tax return. And if he's claiming EMIs, as per accounting standards, it is not allowed. He can only claim depreciation.
Okay, sir. All right, sir. Thank you.
Yeah. Anyone else would like to ask the question? Any query from Nasir sir?
I think there are no more questions. Anybody have question, they can raise hand or ask question or post it. Yeah, I think
Yeah.
And conclude.
So no issues. So participants can just note down the number.
The email ID that we have shown.
Yes, yes, yes.
You can post the email ID in the chat box, maybe.
Yes.
Yeah.
This
Yeah,
is the number.
this email ID you can send queries.
Yes. And the queries will be answered at earliest. So I would like to thank Nasir sir, so giving this wonderful deliberations, and I hope the participants would get the benefit from it, and they would be able to understand the corporate tax for UAE. And if you have any queries, you can just ask through the number or post your queries in the email ID. So with your permission, sir, can we conclude the session?
Yes, yes, sure. Thanks to everyone. Thanks for attending.
And more sessions will be followed by this.
Yeah,
for benefit of all.
yeah. So we are once we have the final regulation, then we can have a detailed session. So that time, I think things will be more clear.
Yes. Yeah. So thanks everyone.
Thank you, sir.
Thank you.
Thank you very much. Thank you.
Thank you.
Thanks, sir.
Thank you.
Thank you, sir.
Yeah, thanks.
Yeah, thank you very much.
Welcome, sir.